Mark, great to see you. Thanks for joining us. Really interesting note, and looking through the kind of four key reasons that you've upgraded it. I mean, the first one suggesting it's close to a trough multiple. I guess my question on that is relative to what?
Yeah, so the market hasn't taken too kindly to our upgrade this morning, so we'll see if we got it right or not. But we try to be patient. This is an asset that we've tracked since its IPO, since pre-IPO. And it's been one of the big structural winners from the COVID crisis. It has traded over 10 times EV to sales. It's now down to 6 to 7 times. So versus its own limited trading history, it's at a trough. At least we felt like take at least 40% of the hype out of the stock. That's how much it's corrected from its peak. That at least gives us a safer shot at it.
And in terms of some of the other factors, the other one that stood out to me is the ways you're quite excited that it can expand.
Yeah, so this is an asset since the beginning that was almost entirely a restaurant food delivery company. What we wanted to see as fundamentals analysts was, and it was a restaurant delivery company just in the U.S. I wanted to see international expansion, and I want to see diversification of the business away from just restaurant delivery to food. They do power 7-Eleven. This morning it was announced that they'll be powering Square's delivery business. And so that's actually now become a reasonably large part of the business. We think about 20% of DoorDash users use DoorDash for delivery of non-restaurant items, non-food restaurant delivery, whether that's 7-Eleven, they power the 7-Eleven Now app, the 7 Now app. So that is just anything that diversifies the business model, allows more volume to flow through this business. It's better for profits. It's better for growth. We've seen this diversification. We think it's a positive.
So, Mark, you like the valuation on DoorDash ahead of earnings. I'm curious who else you like as we kick into high gear here on corporate results, with the setup for tech looking pretty different.
Yeah, Sarah, so I'll start off who we don't like. We put out our quarterly preview this morning. We're seeing, unfortunately, a lot of these negative inflection points in mobility. Just track the Google Mobility Index. It's a free tool. It's a wonderfully detailed tool. But you can see that since about the December 20th or 21st, there's a lot of mobility that's negatively inflected. That's bad for the ride-sharing companies like Lyft and for Uber. It's ride-sharing business, and it's not good for travel names, especially for bookings. So we think there's risk to earnings estimates and the forward outlook from your bookings, your Expedia, Booking.com, Airbnb, those kind of names, Uber and Lyft. On the positive side, the names that we like, DoorDash, actually, who's at the top of the list. We just thought the estimates are relatively reasonable for the quarter. We thought we had a lot of data points that suggested there could be upside. And to the extent that there's a little bit of a mobility shutdown, the delivery companies benefited from that in 20. We think they would benefit from that again.
What about the Megacaps over the last week or 2 weeks, Mark, that have pulled back? Any of them pull back enough that they became screaming buys?
Well, I'll tell you what I find interesting, Wilfred, is those that didn't really move down. Uber has actually outperformed the market year to date as a recovery play. So I like that as one of my top 3 picks. It may have problems near term, but I think if investors can look beyond the near term negative inflection point from mobility from Omicron, I think there's a really wonderful upside opportunity in fundamentals and in valuation for Uber. And then I look at Facebook and Amazon. Both of those have kind of traded in line with the market and slightly outperformed the market. I think they've got a heck of a lot of valuation support right here. And I think they've got really nice stories coming out through the rest of the year. Amazon's been so negatively impacted by this dramatic investment cycle we've had the last year or two. This year and the year after that and the year after that, we're going to start getting a return on some of that investment cycle. Faster delivery means more spend. So I like Amazon. That's part of the thesis on Amazon. And Facebook is just a really controversial name, underperformed last year. I think it sets it up for outperformance this year because we think the fundamentals are going to come through pretty strong for that name.